And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Thursday, second best day of the week. That also means Michael Lebowitz is joining us this morning. We'll talk a little bit about yield curves, Fed, of course, the big employment report out tomorrow. And that may have a big impact on bond yields. In fact, we'll talk about that this morning when we do our Before the Bell segment. In the meantime, get by the website, realinvestmentadvice.com. Mike Leibowitz' latest article is out. It's on the website now, so we'll be talking a little bit about that this morning. But of course, the big news coming up over the next couple of weeks, of course, is the next Fed meeting. And right now, there's about a 50-50 bet going on in the markets in terms of the futures of whether or not the Fed will cut rates by 25 basis points or 50 basis points. And so it's interesting is that the markets are very optimistic, hoping kind of right now for a much bigger rate cut. We'll see what happens. Personally, as Mike and I have talked about before, I don't think they'll go 50 basis points this first meeting just because they may shock the markets a bit, and they don't really want to do that. So I would expect a 25 basis point cut, but hey, it's a 50-50 bet. I'm wrong, right? That's what the futures are saying right now anyway. But outside of that, it was interesting yesterday, the JOLTS report came in the JOLTS report is the Job Opening and Labor Turnover Survey. So this is the survey that economists kind of watch to determine, how many people are trying to hire and those type of things. It was interesting for a couple of reasons. One, it fell pretty sharply yesterday and is now down below pre-COVID levels. So there's less job openings today than there were pre-COVID. Now, Mike and I have talked about the job openings numbers before because, it's kind of very suspect in a way. As an example, restaurants. They tend to always have job openings for waiters and waitstaff because there's such high turnover. A lot of companies were keeping job openings open over the course of the last year or so because they had that out there in the hopes they could poach an employee from another company. They weren't necessarily actively hiring, but they kept the job opening available in terms of listings. So if a really good employee at another firm, maybe was a little bit disgruntled, maybe it might be looking for a change. So when they went to Indeed or whatever it was, Career Builder, to search for a new job, that opening would come up. The company wasn't actively hiring, but if the right candidate would come along, they would certainly hire that person. But they were kind of using it as a bait and hook. They weren't really hiring. A lot of people were applying to these jobs, and we've heard these stories. I applied for 1,000. I've sent out 100 resumes and I've gotten no responses. Well, that's because a lot of these companies weren't really hiring. They weren't looking for college graduates. They were looking for that really key employee that they could grab from somewhere else. And that's typical when an economy is beginning to slow down a bit and you're starting to have some price pressures and profitability issues. Companies still need to hire employees. They still need to produce work, but they don't necessarily just want to hire and train somebody because it's a lot of times that's much more difficult. They're looking for that top quality talent. It's called labor hoarding, and that typically happens kind of in a pre-recessionary period. As companies are really starting to become much more defensive, they start to hoard their labor. And that's what we've been kind of seeing a lot lately. The second thing about the JOLTS report, importantly, was a big negative revision to the June report. And in fact, that has been a trend in the JOLTS report now for the last really several reports, is that when that JOLTS report come out, we go back and revise downward the previous data. So it's not been nearly as strong as a lot of people have expected. But here's the big thing about this, is right now, markets are tracking, and again, we're just off all-time highs, just a little bit from that correction on Monday, but very close to all-time highs. The JOLTS report's been declining. Going back to 2002 when the data first starts, there's a very high correlation between the Job Opening Labor Turnover Survey and the S&P 500 until now. And there's a very big gap between that. And again, you would expect that correlation to exist because earnings come from economic activity. Economic activity comes from jobs. So if job openings are slowing down, employment's slowing down, we'll see what happens. But that brings us to what you need to know before the bell this morning. So tomorrow is the big employment day. And we've talked about before that bonds are very overbought right now. Bond yields very oversold. In fact, this is a chart of the 10-year Treasury yield right now. And again, we're pretty oversold here. We're deviated to the downside a good bit from the moving averages. Again, after we kind of took out these major moving averages, there's been a very nice move lower. We finished yesterday around 3.76% on the 10-year Treasury. There is a bet by traders right now in the markets that yields will be 4% on Friday. So that's a very big move tomorrow, and that would suggest that that employment report is going to come in a whole lot hotter than what markets are currently expecting. And again, so there's this is what the bond market's betting on right now. There's just a big bet being put on of a move in yields back to 4%. Now that wouldn't be surprising, and first of all, I wouldn't expect that to happen in a day. That would be a massive move. It could certainly happen, but I wouldn't expect that. But as we've been saying, yields are very overbought, and so if we have a series starting tomorrow with a much stronger than expected employment report, we get a CPI report that's kind of ticks up a bit for whatever reason. That would not be surprising because yields have kind of gotten so overbought here, they need a reversal. So any data that really kind of puts some concern over where we are in terms of the inflation fight or the weakness of the economy, because this decline in yields is a bet on weaker economic growth and the slower inflation. So any data that comes out that argues against that narrative will cause interest rates to move back up. And we should expect that to happen because, again, yields are very overbought. They've gotten ahead of where the actual data is. So there's going to be a bit of a reversion here. And again, we've talked about previously is that if you've been trying to get into buying, I want to add some more bonds to my portfolio. I don't have any bonds. I've been out of that trade. I want to get into them. You really can't do it here. They're so overbought right now. This is TLT, so this is the price of the bond. Of course, it's the exact inverse of the yield. But again, very overbought, very deviated from long-term means. So we need something that will help pull that back here to provide us a better entry point. So talking about TLT, and which is the 20-year Treasury bond ETF, a pullback to around 95 on that index. So it closed yesterday at 99. So a pullback to about 95, that's about $4 drop on TLT, would actually give you a much better entry point to add bond exposure to your portfolio. Now, again, what gets us there, what causes that to happen, I don't know. But technically, that's what the markets are telling us. And so if there's some, again, coming into tomorrow's employment report, we've got CPI coming out, we've got the Fed coming out in September, later this month. If the Fed comes out more hawkish than expected, maybe they say, well, we're not going to cut rates right now for whatever reason it is, or just 25 basis points and the markets are hoping for 50. That could all lead to some type of reversal here in bonds. And I would expect that to occur. Again, bonds have come very far, very fast. And again, nothing goes up in a straight line. So look here for a correction. It doesn't mean it has to happen, of course, as always, but that's what the technicals tell us right now. And again, we're looking to adjust our bond duration as well. But before we can do that, we really need a better entry point. So we're just kind of being patient and waiting for that to happen. Anyway, that's what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz, let him comment on that commentary, see if he agrees with me or not. And then we'll talk about some of his other nonsense that he always has on Thursdays. So we'll just get into that. Don't go away. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint, Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Good morning. Welcome back to the show. Brant always has a good way of making me feel really old. And so, I told you he puts notes on my page every now and then, just show notes in case I run out of material to talk about or if there's something else kind of going on. He gives me little things to look at. He always puts a little funny comment or something just to, give me something to chat about if I need it. And anyway, so today's, I remember in school, and Mike will remember this as well, but we were studying, you'd study, Civil War history, right? Way back in the 1800s and talk about, what happened, pre-1900 as we got into the Industrial Revolution and those type of things. And so you think about those history lessons, those history stories about the late 1800s, and now kids, my kids and Gen Z kids refer to the 1990s as the late 1900s. So I now feel really old. And this was his comment this morning. Apparently Gen Z kids are now calling the 90s the late 1900s. And I feel like I just drank from the wrong grail in Indiana Jones. And that's a fair statement. I mean, that's, I was talking to my son the other day. I was like, back in, when I was growing up, we didn't have Google. We actually had to go open a encyclopedia to do research. We actually had to read a book. But it's interesting. It just, thanks. I feel really ancient this morning.
Quite all right.
Exactly. So commentary from the late 1900s from Michael Lebowitz this morning. Good morning.
Hey, so that reminds me of a story. I was talking to my daughter a few weeks ago, and I said something that she didn't agree with. Uh-huh. And she goes, "Dad, you're just getting old and not relevant anymore." I'm like, "Thank you." Not relevant.
You're not relevant. You're just old. How old's your daughter?
She's 21 now.
Yeah,
22.
Yeah. That's about where mine are. Yeah. And pretty much we're not relative. What I try to do now just to annoy my daughter, my youngest daughter, she's 18. And so I'll just use their slang. And that really annoys her. She came in the other day and she did something. I said, "Honey, that's really sus." And she's like, "Dad, stop it."
Well, it's better to use it in not the right context because then it really pisses them off.
Yeah, it really gets them going. Absolutely. All right. Well, look, let's talk about a couple of things. So just for the entrance, I was talking a little bit about yields on the 10-year Treasury. There's an interesting bet going on in the bond market right now that yields are going to go up to about 4%. The theory is that the trigger for that will be a really hot employment report tomorrow. We'll see. I mean, I don't know if that's the actual bet. As I was saying, just technically bonds are very overbought. So I think if, traders in general are probably looking at the same thing you and I are technically, going, hey, we're going to get a pullback, so I'm going to take an option position to hedge my bond portfolio, whatever, and that target is probably around 4%. That would be a reasonable retracement on yields at some point. Again, I don't know if that's specifically tied to the employment report tomorrow, but some data like that, like the hot employment report, a stronger than expected CPI report, a stronger than expected PPI report, whatever it is, could certainly cause a bit of reversal in yields. But just want to see if you had any thoughts on that.
Yeah, I agree. I mean, it is overbought, but it's been so oversold for so long that typically when things shift their trend, they can, like we saw with NVIDIA for so long, they just stay overbought for long periods of time. And, we haven't seen yields come down for so long that I think people are looking at these yields and saying, whoa, what happened to 5%? I can't get 5% anymore. Oh, I can only, now we're dropping relatively quickly. And I think people that aren't following this every day are kind of taking a look, oh, no, I got to do something. I got to lock it up. So I think you're getting a lot of stragglers to the bond market that are trying to lock in yields from, kind of 2-year, 1-year money market rates moving out the curve. So there's a lot of that. And again, it's not just retail. This is institutional as well, that some of which have been short. So there's a lot of natural buying demand, especially as the economy shows signs of weakening, of inflation continuing to come down. And the Fed is kind of the cherry on the top, which is going to start cutting rates. And the Fed doesn't just cut rates by a few 25 basis points increments. They cut by a lot. And the market may be starting to, as you would say, suss that out.
So, yeah, it's going to be quite interesting. And again, there's always a narrative, right? The markets are always looking for some narrative to provide to some action.
Right.
And again, you and I have been talking about, for the last couple of weeks, bonds are very overbought. You kind of, if you have been waiting to buy bonds, you waited too long. Right now, you got to be patient here and wait. And again, it's like the stock market, anything else. We can, as you said, markets can remain overbought much longer than you think, but eventually you're going to get a correction. Bond markets, stock markets, they tend to remain overbought just long enough to suck everybody in, right? And
right.
that's how they work best. And again, last year nobody is like, bonds are never going up again. I can't tell you how many articles were being written by very respectable people. Bill Gross, interest rates are going to 8% now on the 10-year Treasury, and they've been going lower ever since. He has an almost perfect track record of calling the wrong direction on bonds going back to 2013. He makes these calls on a regular basis and bonds going the other direction. But there was a lot of people betting on higher interest rates, and we were making the arguments that the economic data, the environment we're in, didn't really support that. The economic data still doesn't support much higher rates, but that also doesn't mean that interest rates just go in a straight line down. They didn't go in a straight line up. They're not going to come in a straight line down.
But Lance, let's talk about the last couple of weeks.
Sure.
Because I think there were a lot of anxious bond investors last week. Bond market actually wasn't trading well. And on Friday of last week, before the long weekend, it got hit, pretty hard. And I got a couple emails, oh, what's going on? Are yields going all the way back up? Blah, blah, blah. And I didn't have a great answer because there was really no news on Friday, especially. Nothing big was happening. It was a holiday weekend, so it was really quiet. Then on Tuesday, Monday was a holiday. Tuesday, we learned that that there's a huge corporate issuance coming to market on Tuesday, Wednesday, probably even Thursday. So what happens is when a lot of corporations come to market to issue bonds, they hedge themselves. So prior to issuing a bond, once they know when they're going to issue it, they short treasuries, usually short treasuries. And what that does is if yields go up, their treasury price that they shorted will go down. They'll make money, which will offset the higher yield that they pay when they go to issue that debt. So what happens is they short treasuries in advance of the issuance. Then they issue their debt, and as they're issuing the debt at the same time, they're buying back their treasuries. So sure enough, on Tuesday, Wednesday, we saw decent rallies in the bond market on Tuesday, especially on no news. There was nothing. Big down day Friday, big up day Tuesday. That tells me that there was just a lot of corporate debt hedging going on, the shorting and then the buying back of the short. And the reason I'm bringing that up is because there's a lot of flows in the stock market, in the bond market, that we, and by me, I mean a lot of professionals, the media, just don't know that are going on. And they can have short-term impacts on these markets, not really long-term impacts, but short-term impacts, making it very hard to explain the day-to-day gyrations of stocks. NVIDIA is another good example. Down 10% the day before the Department of Justice talks about antitrust. So clearly someone knew something, but the day NVIDIA fell 10%, there was no great explanation.
Right. We explained that here on the show yesterday that Nancy Pelosi knew. And so that was her clearing out her position, obviously.
Actually, I heard she still owns it. So for once, she was on the wrong side of the trade.
Really?
Yeah.
So,
believe it or not.
Interesting. So, it's very interesting that there are all these things that are going on, and that's what makes investing so difficult for people, right?
And everyone wants an explanation as to why, and sometimes there are no explanations at the time. Usually, you'll get an explanation later if there's a really sharp move with no news. But sometimes you have to accept that there are some really big players out there that are doing some big trades that can have a big impact on the market.
No, exactly. And again, we're also seeing some interesting divergences. I was talking about, earlier, if you take a look at the JOLTS survey, take a look at that data going back to 2002 and overlay the S&P, they look almost identical until now. There's a big divergence between the markets and that data. We're seeing a very similar divergence between economic surprises, sales surprises, and earnings surprises. Earnings surprises are very elevated, and sales surprises and economic surprises are declining sharply. Well, how do you have an earnings surprise when your sales are declining, right? Well, that's buybacks, that's accounting, mechanisms, et cetera, that all there to help boost earnings. And these things can last for a while, but eventually the data catches up with the market. So, again, it's we're kind of in this very complacent period in the markets. And despite, the fact that we've had this correction on Monday, markets are near all-time highs. You're up 16%-ish this year so far. I mean, it's been an outstanding year for the stock market this year. And this is coming on the heels of a very outstanding year in the market last year. So we've had two, near 20%, gains in the markets over the last 2 years, despite concerns about economic weakness, higher interest rates, et cetera. I mean, the markets are very detached from what you would normally expect in a high interest rate, slowing economic environment. We'll touch on that when we come back from the break, talk about Mike's article on the inverted yield curves because it feeds right into that narrative and what that means for stock investors going forward. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife has this KitchenAid mixer. I bought it for like 15 years ago. And this is before, I guess, the invention of lighter materials. I'm not sure. Brent's nodding his head. This thing probably weighs a good close to 100 pounds.
It's a boat anchor.
It's actually shaped like a boat anchor.
The Real Investment Show podcast.
If you ever lose a boat anchor, just throw a KitchenAid back there. It also works as a propulsion system.
At realinvestmentadvice.com.
I'm not banging on KitchenAid. They're awesome.
It'll run forever.
And they run forever. Need to get rid of body. Just
tie a KitchenAid to it.
Tie a KitchenAid to it.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. If you fail to plan, you plan to fail. Richard Rosso and Denny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, talking just before the break a bit about the markets, which are very detached from underlying economic realities, fundamentals, etc. You know, you don't have to look too far to see data that is a bit concerning. Now again, we have to go back to the very basic understanding that earnings don't just magically appear. They have to come from economic activity. In other words, you and I going out, we shop, we buy stuff from Amazon, whatever it is, but that's how Amazon makes them. If we didn't order anything from Amazon for a month, Amazon would be out of business, right? I mean, that's where their revenue comes from, right? So we've got to go online to Amazon, we got to order stuff, and that's how they make their money. And from those sales, right, that's their sales, they sell us stuff. They then pay all their expenses, pay their taxes, pay whatever else they got to pay. And at the bottom of that is their earnings, right? That's their net income and derives earnings per share. So earnings have to come from economic activity. And what's interesting, you take a look at the job opening labor turnover survey, you look at the employment trend, or I should say unemployment trends, et cetera. There's clear weakness going on, but yet the market is continuing to grind its way higher. And we're very near all-time highs. We've had very big years. Last year, this year have been very strong up years in the market. A lot of that driven by AI and tech, of course. We've talked about that. But it all relates back ultimately to economic activity. So again, and this is one of the big kind of conundrums, has been, and there was this really great article out on CNBC yesterday talking about the yield curve has now normalized, which after being inverted for over 2 years now, the yield curve for about 27 seconds, it actually uninverted and then it went back down a bit. But it's right at the cusp of uninverting. So CNBC says, see, no recession risk now because the yield curve has normalized. We're back normal on the 10-year, 2-year. Now, as you know, we track 10 different yield curves. And I've got this chart coming up in our weekend newsletter. But out of those 10 yield curves, only one is uninverted, right? And that's the 10-year, 5-year. The 10-year, 2-year is very close to uninverting, but has not inverted yet. But there's still a lot of those other spreads that are not uninverted at the moment. So again, we still have a very high level of economic concern. But again, so CNBC states, hey, nothing to worry about, Mike. The yield curve is uninverted. We didn't have a recession, and so we're now back to kind of a Goldilocks economy. You kind of wrote an article, second part of an article yesterday talking about the yield curve in particular and what it means particularly for stock investors. So take it away. What are your thoughts?
Yeah. Yeah. So the yield curve is like GDP, like the labor market, like inflation, a very important economic signal. And, most common is the 2-year, 10-year yield curve. So all that's doing is taking the difference between the 10-year yield and the 2-year Treasury yield. And typically, it's not inverted. In other words, the 10-year yield is higher than the 2-year yield, which makes sense. We're a growing economy, and there's time between if you buy a 2-year and a 10-year, so you should get some sort of yield premium. That's the way it typically is, and it's 90% of the time it's in a state of a positive yield curve. But what we have found time and time again is that prior to recessions, prior to Fed rate cuts, the yield curve can often goes into an inversion. In other words, the 10-year yield goes lower than the 2-year yield. And what that's really telling you is that the Fed is keeping rates high or bringing rates up. So the 2-year is very attached to what the Fed is doing. And it's going right up with Fed funds. But at the same time, as the Fed is raising rates, they're trying to clamp down on economic activity and inflation. And therefore, inflation and economic projections start declining. And the 10-year, longer-term maturities are much more, not much more, but more so based on, kind of longer-term forecasts, not what the Fed's going to do month to month. So as those projections start falling, the 10-year may not fall, but it doesn't rise nearly as much as Fed funds. And that's how you get the inversion. So I'm going to show you something up on my screen here.
Okay.
Can you see that,
yes.
Lance?
Yep, we're good.
Okay, good. So this is from the article, and it shows the yield curve back to 1985. And there are 5 circles on it. I'll try to explain this for those not able to view the screen right now. There's 5 circles, and they're all occurring after the yield curve has inverted when it uninverts. And what we have found the prior 4 times, the 5th time is actually right now. It's close. It just uninverted a couple days ago. Is that it can take anywhere from 84 days to almost 3/4 of a year from when that uninversion happens to when a recession is called. Now, here's the tricky part. The NBER is the one that calls a recession. And quite often, they'll backdate it. So they may not have called those recessions when you see it on the graph. They may have been called 6 months or 9 months after that fact.
Well, just real quick, that's a good. Bring that graph back, Brent, for me. A good example of that, and again, just so people understand what you're saying, that the National Bureau of Economic Research always waits for the revisions to the economic data from the Bureau of Economic Analysis before declaring the recession. So there's always a posting. There's only one period in history going back to, I think it's in the 1950s, where the actual call was roughly about 3 months after the recession started. But take a look at 2008 on this chart. It was 280 days from the uninversion of the yield curve before the start of the recession. However, the National Bureau of Economic Research didn't date, that start was December of 2007 for the recession. The NBER didn't date that recession until December of 2008. So technically you can take 280 days, add 365 days to it, because that was the real length before you actually knew there was a recession there. And that's the problem with a lot of this. And Mike, I'll give it back to you. But, that's the problem with a lot of this analysis, that when we look back historically, we say, oh, yeah, well, look, every time this occurred, there was a recession. Every time this happened with employment, there was a recession. We did when that event occurred historically, we didn't know we were in a recession until months later, 6 months, 9 months, 12 months later. We didn't actually know we were in a recession. And so the media is saying, hey, look, there's no recession. And then 12 months later, we find out we're in a recession because they revise all the data. Go ahead, Mike.
In March of 2008, Ben Bernanke, chairman of the Fed, did not know we were in a recession.
That's right.
And according to the NBR, it had started about 3 or 4 months prior to that. But what you'll notice from the graph is that in those prior instances, and 2020 is a little unique, that was kind of a man-made, they're all man-made, but it was very unique. So if you focus on the other three, what you'll find is that once the curve uninverts, gets back to a normal positive shape, it zooms ahead. And that's because the Fed is usually starting to cut rates rapidly. And, other than 1995, where the Fed cut rates, but minimally, where the curve was not uninverted, you can see that the Fed cuts aggressively, and it's been roughly 5% every time, except for 2020, and that's because rates were only at roughly 2.5, 2 3/4. They could only cut to zero. So what this is telling you, purely based on history, again, everything's been so peculiar these last few years, who knows? But what you can see is that the yield curve is going to steepen pretty aggressively if it follows the past. So what does that mean? It means that 2-year notes are probably going to fall rapidly, which means the Fed is going to cut rapidly, and 10-year notes will fall, but not as rapidly. So you're going to end up steepening the curve. Now, that sounds scary. It sounds like I got to sell all my stocks and I got to buy bonds right now. But the fact of the matter is that there's still a lot of time. And, you can see the day counts up there. The shortest was 84 days. Even that is 3 months. And you can see that the S&P between the uninversion and the recession was up 3 of those 4 years. So there's no guarantee that the market's just going to fall off a cliff the second the yield curve uninverts, because no one knows there's a recession coming.
Right.
And, again, Bernanke in 2008 didn't know there was a recession. We were already in the recession. And that's what makes this difficult, and why you have to understand that it's a signal, and it potentially means poor returns. And you can see here in bull steepening periods, and there have been
Mike,
5 of them.
Yeah, Mike, hold on. Can you scroll your screen up just a little bit? Okay. We're working on it. There we go. We're getting it.
Okay. I apologize for that.
That's all right.
But bull steepening periods are not friendly to stocks. Just about every stock has a negative average return. Some are much less negative than others, but almost everything is either flat to negative. You can see gold and gold miners have done very well. Staples, dividend aristocrats were barely up on
Mike,
average.
Hold that thought right there. We got to come back to the break. But leave that chart up, because when we come back, we'll pick up on that chart, because you make an interesting point in the article about where gold is trading now versus what's happened historically. And so we'll pick up on that after the break with Michael Lebowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So talking a little bit about yield curve inversions and the bullish steepening that's going on right now with yields, which is actually bearish for stocks. Now, this is also for all these charts and graphs. If you go to our website, realinvestmentadvice.com, just click on the latest article by Mike on the top of the page. And all these attendant charts and graphs are there, so you can kind of go through. And there's more in that article than what we're going through today. So it's just, that way you'll have it. But Mike, let's pick up with that last chart on bull steepening and returns from various sectors and markets. And, pretty much stocks don't do well during bullish steepening of yield curves. But, gold and gold miners tend to do well. Staples hang in there pretty well, kind of the defensive sectors of the market. But further down the article, you make a very interesting point about that. Now, because I don't want, look, gold has been doing very well this year. I don't want anybody to think that, we're anti-gold. But you make a very interesting point in the disclaimer about these expectations. And I just wanted you to address that before somebody runs out on this data and starts trying to buy gold today.
So it's important, first of all, to define what a bull steepener is. Every day, the yield curve is doing something. It could be a bear flattener or a bull steepener. So you have to look over longer periods of time, and is that change in the yield curve persistent? And we have persistently seen a bullish steepener. Bullish steepener, the bull or bear, if you're saying a bear steepener, bull steepener, refers to price, bond prices. So in a bull steepener, bond prices are going up, yields are going down. Steepener or flattener refers to the shape of the yield curve. A steepener means that the yield curve is steepening. So the 2-year yield is getting more and more. The difference is increasing between the 2-year and the 10-year yield. And my first part of the article goes through all the yield curve shapes and gyrations, and it'll help you better appreciate it. But what you'll notice is, so we had to define these, and the current bull steepener is only about 10, 11 weeks long. We said to be a bull steepener, it had to be 20 weeks. So there's still 10 weeks to qualify. But what's important
real quick,
is...
let me ask you a question real fast about that. So, where, we're talking about this bull steepening, and as you just said, it's like we're about 8 weeks into this or so far. But how did you determine the start of that starting point of that bull steepener?
Well, of the current bull steepener?
Yeah.
I haven't really. I'm assuming that this bull steepener becomes a 20-week bull steepener. It may not, and then what I'm going to talk about gold may not matter. But if we are in a bull steepener that's going to last 20 weeks, so another 10 weeks or so, then these stats become a little more relevant because they are consistent across the other 5 periods. So what you see here, let's focus on gold. In the 5 prior bull steepeners, gold has been up 13%. Currently, gold is up 10%. So if we are going to persist for another 10 weeks in a bull steepener, we're in a quote RIA official bull steepener. So if we're up 10% and gold is up 13% on average, there may only be 3% of upside. So that's something to keep in mind, but there's a kind of a dark cloud on that horizon. And what you'll see, let me just, here we go. What you'll see is that gold is 13% on average, but it also has a 6% drawdown from the start date of the steepener. So in theory, if it follows what's happened in the past, gold could fall by, it's up 10%. It could have a 6% drawdown, meaning it could fall roughly 16% and then rally to be up 13%. So the path to pick up that 3% gain could be pretty volatile. And, we've seen that a lot of times. When stocks get hit, gold often follows. It may recover first. We've seen that quite a few times, but it also struggles when the broader market struggle because investors have to sell, and they sell what's most liquid, and gold tends to follow markets in times of volatility.
Yeah, and we've seen that. There's been a decently high correlation between stocks and bonds over the last, between stocks and gold over the last couple of years in particular. And it's kind of what you would expect is that if there begins a drawdown, in stocks, and you start getting margin calls at some point for, leveraged investors, to your point, everything kind of starts getting, sold all at one time. So, to your point, we may wind up gold actually performing very well during this bullish steepener, but it could be a very bumpy ride getting there. And you kind of wind up potentially, where you are today, maybe you wind up in the same spot, a year from now. And that actually goes into line with something that we talked about in our daily market commentary, I think last week, is that if you look at gold on a monthly basis as a good example of this, it's 3 standard deviations overbought on a monthly basis. It's extremely deviated from long-term averages, and we're talking about 4-year moving averages, et cetera. Those are extreme deviations, and historically, when you're that overbought and that deviated, you're going to get a price correction at some point. Now, what causes that price correction is like everything else we're talking about today. We don't know. What's going to cause yields to go back to 4% so we can get a better buying opportunity for bonds? Have no idea. It could be an employment report. It could be something else. What causes gold to correct? Who knows? But at some point, somebody somewhere says, I'm out for whatever reason it is, and it causes a cascade of selling, and then you'll get a great buying opportunity again, for that asset, and to rally into the year. So, as is always the case, like Mike and I talk about, it's always important, manage your positioning no matter what you're in. Doesn't matter whether it's small cap, mid cap, large cap, gold, stocks, whatever it is. Manage your positioning, manage your risk, take profits when you have them, and control your portfolio. But Mike, any kind of other advice on that as far as your article is concerned?
Yeah, I mean, like you said, it's not just gold. Staples have been on fire recently too. So they could be setting up for the same kind of trade where they end up being okay, but you feel some pain along the way. So it's, trade the markets you have, appreciate the risks, the signals, the omens that are being thrown at us. And the technicals, are very important. The other thing is, if you look at what's been performing really well the last few weeks, it's those those sectors, factors that tend to do well during recessions. So the market may be kind of jumping onto this, getting a little ahead of itself to this. There's a recession coming in, could be 280 days like some of the prior instances, but trying to front run that trade and front running it may hurt, you may get hurt. There may be a much better opportunity to front run it when things actually get worse, as crazy as that sounds.
So, and again, as is always the case, markets can do, nobody knows what's going to happen. Markets can do a whole variety of things that nobody ever intends for them to do, and logic would certainly not predict. I just published an article last week talking about valuations. Valuations are very expensive from a historical standpoint, but valuations have been elevated for the last 25 years. Because of monetary interventions, the Federal Reserve, et cetera, this has just been, stock buybacks, et cetera, have all lifted valuations far beyond what historically we've seen. But there's been all these other influences that have really undermined what a lot of historical analysis would tell you would be the case. Again, historically at 23 times earnings, that has been the peak of bull markets historically going back to 1900. Until we got into 2000, the Fed started cutting interest rates to zero, got to 2008, and we've been lifting valuations now. The long-term median valuation is no longer 13, 14 times earnings. It's now 16, 17 times earnings. So we've provided this almost permanent lift to valuations now that historically hasn't existed. And it's hard to explain that, right? And so this is where a lot of people go wrong with their investing, is they look back at long-term historicals and go, well, this is the case, it's always been, so now I'm short the market or whatever it is, and then markets keep going up. And that's the very frustrating part, but that's why it's so important. The analysis that Mike and I do is to try to help navigate those type of environments. Mike, go ahead.
Yeah, real quick. This article is not a call to action. It's not saying sell everything and sit on your hands. It's a part of your playbook. It's a way to prepare for what may be coming. Not definitely coming, may be coming. But when things happen in the future and you have a playbook and you know what to do and you know what's happened in the past, it makes it much easier to react. Your emotions don't get tied into it. You can react on facts and history. And, so think of this as something to keep in mind, keep it in the back of your head, but don't just go out there and buy or sell everything on this list based on what happened in the past. Because even if that is what's going to happen, it may not be for another year from now.
Right. And that's the big thing. Timing is always the important thing. And, Howard Marks once said that, being early is the same as being wrong. So, timing is very important to this call. The analysis is important. Don't mistake the analysis, but also understand that things can take a whole lot longer to play out than anybody could ever imagine. That's why we have to, as Mike said earlier, we have to manage the markets we have today, not for the markets that we think is going to be down the road. We'll get to that point, and we'll see clear technical signals that say, hey, this has changed. There's a technical trend change to the market. So what Mike said a year ago is now coming to fruition. Now we have to take action. So again, that's why technical analysis is as important to your portfolio, just as fundamentals are. All right. Wraps up the show for the day. Have a great day. Thanks so much. Richard Rosso, Danny Ratliff in tomorrow, and we will be back on Monday with the next edition of The Real Investment Show. Have a great weekend.